Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy.
Greg, thank you so much for joining the podcast to talk about your recently released book, The Savvy Investor's Guide to Building Wealth Through Alternate Investments. So I'd just like to start by asking, what was your influence for writing the book?
Well, I have been working in the area of alternative investments in terms of helping prepare candidates for the CAIA designation, the Chartered Alternative Investment Analyst designation, for about 15 years now, and have written on several different topics related to alternative investments. But one of the things that I think I noticed out there in the marketplace is that there really wasn't sort of a simplified way of regular readers being able to really understand the essence of alternative investments. So this was a great opportunity to kind of introduce alternative investments to a wider market.
Yeah, it's interesting. So you saw obviously an issue with your students being unable to find that source, so you thought you'd provide it for them.
Well, even more so than students, I just think regular investors. I think when you say the word alternative investments and you start talking about things such as hedge funds, it makes a lot of people nervous because they don't know that much about it, and gaining access to some of these investments seems very elusive.
Yeah, definitely. And I was quite interested when sort of reading the book, sort of the how alternate investments is actually defined. And, I was quite surprised. So would you be able to expand on that a bit more, and sort of how do you define alternate investments?
Yeah, so when we think about traditional investments, so I'll kind of juxtaposition that question in terms of a comparison. When we think about traditional investments, we think about stocks, bonds, and cash, sort of our traditional way that most investors have built their portfolios. But their alternative investments, it's hard to kind of put your hands around it and say this is what characterizes all alternative investments. But in general, many of the alternative investments, we see more what we call black box strategies, or strategies that are not exactly laid out for you in detail. So whereas an investor can understand a dividend yield, when we start talking about the components of, say, private equity or venture capital, it becomes a little bit more elusive. So it requires a lot more homework on behalf of the investor. And in many of the different types of alternative investments, direct access through investment requires a classification, which we call accredited investor, which is a certain wealth level because of the extra degree of sophistication and the concern that people could be able to lose a lot from that. And I think along with that, but it's also understanding that many of the types of returns that can be generated from alternative investments can be achieved through, for example, ETFs or mutual funds that try to mimic those strategies.
Yeah, definitely. And then do you want to maybe talk about I think there was 5 alternate investments that actually talks about in the book.
Yeah, so the Savvy Investor's Guide to Building Wealth Through Alternative Investments basically focuses on 5 types of alternative investments. The book opens up with a discussion on hedge funds, probably what's most well known for investors, even if they are a little squeamish or concerned about them. Then we talk about the world of private equity. Private equity can include things such as venture capital or buyout funds. And then we talk about real estate. Now, some folks think about real estate as being a part of their quote unquote portfolio, but generally when we talk about real estate here, we're talking about commercial real estate opportunities. And then commodities, typically accessible through commodity futures contracts. And then we talk about infrastructure assets. And this is something that a lot of folks sort of take for granted. These are that would be an investment opportunity, which could be anything from looking at basically tollways, airports, and things that, again, sort of make up the fabric of most of our country. So that's kind of the categorization in the book. Hedge funds themselves are actually broken down into a whole variety of different classifications in themselves. So they're even harder to kind of define as an individual class without kind of breaking them down further as well.
Yeah, I found that quite interesting in the book. Everything's like so specific, and it's really good how it's set out. I thought it's like everything's explained like that. But yeah, so I found that quite interesting as well. Like infrastructure, I'd never really heard of investing, and as you said, it's something that's just a lot of people overlook.
Yes, and I think that for many folks, this is certainly a big topic. I think coming out of the financial crisis of 2007, 2008, and then what we're going through in terms of the pandemic, we see a lot of countries talking about investment in infrastructure as a way to not only improve their country, but also to kind of jumpstart the economy. So I think understanding, what infrastructure is, why it's necessary, who owns infrastructure, and, the different classifications that can go along with that. And then obviously there's a lot of focus right now, and I think we'll continue on ESG, environmental, social, and governance principles. And we know that, for example, greenfield investments versus brownfield investments are something in infrastructure that, we kind of talk about in the book as well, about whether we're looking at an existing piece of infrastructure that can be improved or something we're creating new, and trying to do that in an environmentally friendly way.
Yeah, and I think obviously the US is at the forefront of the the investment bill and everything that's happening in there, and I guess we've seen the lowering of barriers as well with how people can invest. So there's greater opportunities for people, aren't there?
Absolutely. In fact, in the book we outlined some examples of some infrastructure stocks that are out there, and also about ways that you can invest in infrastructure, say through mutual funds, which is again is a pooled investment vehicle, is probably the most common way people can gain access. So it doesn't have to be literally you're putting down 10% on a new tollway. It's an opportunity to gain the types of returns you could get by being able to have an indirect investment in those types of opportunities.
Yeah, definitely. So I'll go into sort of private equity because he says it's one of the core sort of alternative investments as mentioned in the book. And we've seen sort of a massive growth over the past few years of private equity and, acquisition of both, public and private companies. But do you think there's still opportunities available, or is it sort of overcrowded at the moment?
Yeah, so one of the area, yes, I do think there are opportunities, but I think investors have to be very careful. What we see in general that distinguishes, say, the traditional investments from these alternative investments is that there's a wider cross-section of returns that you see from top to bottom in the alternative investment classifications that you observe compared to the traditional investment. So if we looked at equity analysts, they would fall in a fairly narrow band in terms of their performance, but a much wider band of performance that takes place with alternatives. That means that being able to do what we call due diligence or research to be able to understand what are the characteristics that are defining a great opportunity, and in this case, private equity would be important. And I would also point out that in the traditional markets, we don't see any evidence of return persistence. In other words, a manager that finishes in the top quartile, for example, in terms of performance one period, is no more likely than someone else to finish in the top quartile next period. That's not true in the alternatives. To some degree, not all alternative categorizations, and certainly there's some weak evidence in certain subcategories within alternatives, but there is some evidence of return persistence, which means that if you can gain access to either directly or indirectly through a top quartile manager one period, there is a greater than 25% chance, which would be, again, random, that you will end up in the top quartile again.
Yeah, it's interesting. I think if you link that to maybe venture capital and all those, what we sort of see is a lot of the, best investments, they get attracted to the top range, don't they? Would you say that's potentially a reason for that, or?
Yes, and especially when you talk about venture capital over a period, let's say we're looking since 1990, venture capital has done extremely well. The expected returns are quite high, but if you look at what's happened, say, over the past decade and a half, that would not be the case. So there is time periods in which certain alternatives are doing better than others, but it's also recognizing what you're getting into, and again, your ability to be in a space which does offer profit potential. So while certain types of private equity right now may be less in favor than they've been historically, there are opportunities that are out there. One of the concerns I would also mention, though, is that when we talk about venture capital having a high expected rate of return, if we look over a long period, it also comes with, as you might expect, a high degree of risk. So it shouldn't surprise us that we have some periods where we have subpar performance. The other thing I would just mention is, interestingly, over the last decade or so, we've seen an increasing correlation, a relationship that's existing between the public markets and the private markets in terms of equity. So again, you're not getting that great of diversification in terms of mixing that in with a traditional portfolio, as you might have seen, a few decades back.
So you're saying there is that sort of the results are quite similar in private and public. Is that sort of what you're saying, or is it?
Yes. Well, I would say that they tend to move together, even if certain elements of the private equity markets have not done as well as the public markets in more recent history.
That's interesting. And why would you say, is that just favorable to economic conditions, or do you have a theory about why?
Well, I mean, I think so. There are several theories out there as to why that could be the case, and this goes for a lot of alternative investments. And that the market space became relatively more crowded over the last couple of decades. So there are certainly some outstanding managers and firms that are out there that have done great work. But the incentive structure that's set up for many alternatives probably attracted a lot of folks that don't have the same degree of expertise that people that had originally moved into this market in the frontier stage existed. Because you're looking at a couple of different levels of compensation. So in traditional investments, most managers are making their compensation off of what we call assets under management, a percentage of assets under management. In the alternative space, there's an incentive fee structure that's typically associated with many of our alternative investments. So you've heard the old traditional 2-20, so 2% assets under management, 20% incentive fees. So that draws a lot of folks in. Now, we'll say more recently that incentive structure has been a little less generous. So even though that's kind of traditionally the way we talk about compensation structures and alts, it has been lower in terms of the incentive fees, especially during the 2010s.
Yeah, it's interesting. So you'd say more competition, I guess, lowering the barriers of both, people who can actually manage money as well as investors would have probably helped.
Yeah, and again, you have folks at they're doing extremely well at the top, but there's also a lot of folks that do not perform well. And again, as we look across the spectrum of alternative investments, we have a tremendous amount of hedge fund failures each over a period of each year. But at the same time, there are tens of thousands of hedge funds that are out there.
Yeah, and I think I've read a statistic where a lot of the, you look at the performance of hedge funds, but a lot of the time it doesn't take into account the ones that have actually failed and have potentially lost a lot of money. Yeah,
and unlike, say, for example, a market index like the FTSE or the S&P 500, where the composition of those indices and every company is being represented in that index. When we look at performance metrics in the alternative world, they're often put together by vendors, and they're based on voluntary cooperation in terms of sending in your performance. So yes, it's highly unlikely a failing hedge fund is going to say, hey, vendor, make sure you get my negative 100% return in there for this particular period because I failed. So yeah, you're not going to get some of those things being reported.
Yeah, definitely. And that's what you said as well, that the reason that they can be so risky is because there is that secrecy behind it. And, from one side, you understand because obviously they want to protect, if they have any, potentially things that are going to help them beat the market. But yeah, on the other hand, it could be negative for the investor.
Yes, absolutely.
Yeah, perfect. And hedge funds haven't performed as well as as you'd say a lot of the other alternative investments over the past 10 years. We did see last year that obviously during the heavy volatility, they did quite well. Do you think that with continued volatility, if we do see that they will sort of reemerge as potential high performers?
Well, and I think you hit the nail on the head. Many alternative strategies and hedge funds are built off of taking advantage of volatility. And so as a result, during periods where we lack volatility, strategies that ordinarily are doing quite well do not tend to do as well. So global macro funds, which would be a perfect example of that, things have tempered a bit, but they used to be noted for taking on excessive amounts of volatility back in the 90s. Now that's changed somewhat over time, but during periods of high volatility, you see global macro funds typically doing better. And also you see what we call managed futures, or the use of futures contracts, also doing well. So they were the darlings coming out of the financial crisis of 2007, 2008, when so many of the traditional investments were not doing well, but then have performed poorly under less volatile conditions. But again, in the hedge fund world, as we talked about earlier, there are so many different sub-classifications that take place. Again, it's hard to generalize across all hedge funds and say, they're not doing well as a class, because certain subcategories can do well when others are not.
Yeah, definitely. And a lot of the times, these funds aren't even hedging at all. It's just a way for them to be less regulated, isn't it? Basically.
Yeah. The general strategy for a lot of hedge funds is to be able to take both long and short positions. So the ability to, if you will, have ownership in a particular, say, security, but also to take a short position in other securities. So short position, essentially borrowing somebody else's shares and selling them with the promise to return them later on at what will be hopefully, from their perspective, a lower price, and then profiting from the difference. And so with that, they're able to lower what we call the systematic risk of the investment, while their target is still to try to provide the same sort of returns you would get with equity. So they do better on what we call a risk-adjusted basis. But once again, that's the promise. That's what they tend to promote themselves. But in recent years, many of those strategies have fallen short.
Yeah, definitely. So I guess it's you said the sort of alternating performance basically between all these alternative assets, where sometimes some do well and then it changes to the other type. So in terms of for an investor diversifying their portfolio, I know you sort of say a lot of these strategies can be risky. So trying to keep it maybe to a low percentage of their portfolio.
Well, I think it's a great question you just asked. So on a standalone basis, some of these strategies can be quite risky, but investors should not be looking at the standalone risk per se of an investment, but how it fits into their overall portfolio. So for example, we talked about private equity a few moments ago. It doesn't necessarily provide a lot of diversification because they're highly correlated with public equities. But you can take another type of alternative investment that could help significantly reduce your risk in your portfolio. So you have to think in terms of both risk and return. And so if I take, for example, commodity futures, and we have a chapter on commodities in here as well, commodities in general, commodity futures do not have much of a relationship with the traditional market. So they're a great diversification tool. Even if they're not necessarily providing return enhancement, they do tend to bring risk down in the portfolio. So investors, if they think about sort of on a risk adjusted basis, how their performance looks, they're able to achieve perhaps the same return with less risk in their portfolio.
Yeah, definitely. That's quite interesting. So you say, a lot of people, they'll diversify by going into different industries with equities, but then you'd say take it a step further rather than just growth value, maybe, other industries taking into commodities and other things like that.
Yeah, and I think we have to be careful, though, too, when we talk about what type of investor it might be appropriate for. Certainly many of the alternative investments that we talk about in the book talk, for example, about private equity. We know if we are going to invest in, say, venture capital, if we're tying that up in a literal venture capital fund, if we qualified, you would be looking at a 7 to 10 year commitment. So obviously, in looking at some of the underlying instruments, I think investors have to think about what we call the investment policy statement, and that's to be able to look at concerns with not only liquidity, their ability to have more liquid investments, but what does their risk tolerance look like? Can they tolerate perhaps the risk that would be associated? Hopefully in portfolio context is where they're investigating that, but some folks look at it on an individual basis. So there are obviously some more like ETFs or mutual funds that can give you mimicked exposure to that, which don't have those concerns. But especially when we're talking about the underlying instruments, I think investors have to make sure that they can handle the risk and that they can handle the liquidity issue, because the tie-ups that go along with that, it's very different from, say, investing in a stock where the markets are relatively liquid. It's no trouble really typically for you to sell a stock, but to sell out of ownership in a private equity fund, there's a very small secondary market that's starting to develop, but there's still considerable risks associated with trying to get out.
Yeah, definitely. And that's the same thing, whereas especially if you're a part of a fund and they're trying to maybe sell a business, a lot of people be like, hang on, why are they selling this business? It must not be performing well. I think that's another thing as well.
Yes, and it causes what we call significant discounts in terms of the price that would be offered relative to a proxy for what would be value. Again, another issue that you run into in the alt space is that while we could look up what, say, IBM stock is selling for today, many of these alternative investments don't have that secondary market where you can get an actual price. So the valuation is based on, again, some sort of model that's giving you a proxy for the actual value.
Yeah, definitely. And you'd say there's also the lack of information compared to sort of public markets. And I guess that's why there's those greater opportunities to potentially make, those gains, because there might be an arbitrage opportunity where people just haven't understood the value of the company.
That is correct. Absolutely.
Or other things. Yeah, perfect. So what would you say is sort of the most important? So when someone looks to implement these into a portfolio, why do you think they should do that sort of alternate investment? Is it just to provide, diversification, or?
I do think that diversification would be a primary reason why many investors would be looking at alternative investments. However, some of these strategies can also provide return enhancement as well. So there's an opportunity, if you will, to potentially increase return. Many of these strategies offering the opportunity to reduce risk. And if we think about that risk-return trade-off, the ability to provide an enhanced risk-adjusted performance.
Yeah, definitely. I guess when you say if it's sort of lower volatility as well, it might be an opportunity for, maybe not with hedge funds, but for other investments. If you're looking for greater gains, it might be willing to take more risk on.
Yes. So on a standalone basis, we look at two metrics when we say if we add this particular investment into the portfolio, what's it going to do from a risk perspective? We certainly are concerned about the standalone risk of the investment. But we also would be curious about what the relationship is between the correlation of movements and what our current portfolio has versus what we're considering to add in. So those two together will determine whether or not your portfolio, which would include that potential investment, the risk levels would be higher, potentially the same, or lower.
Yeah, definitely. So we'll go on to sort of commodities. You said is a key aspect that's mentioned in the book. We've recently seen CPI increase, but there's also sort of been a limited impact on commodities such as gold and silver that don't have the supply issue. Obviously, lumber and other things went up quite a lot. But do you see sort of commodities still as a hedge against inflation, or are they more sort of a hedge maybe against uncertainty?
So yeah, commodities, traditionally we think of them as potentially being a hedge against inflation. So what that means is that during periods of higher inflation, if you think about what that means for the bond market, inflation tends to drive yields. And so higher inflation means higher yields. And we have an inverse relationship between yields and bond prices. So most bonds in the bond market, most bonds are not going to react favorably to concerns with inflation. We also know that for equities, to a certain extent, can absorb inflation as long as you're able to pass on increased cost of your inputs onto your customers. And so if you can keep your margins in a good space, then equities sometimes are helpful from an inflation standpoint. But we also know during periods where there's unexpected inflation or excess inflation, that neither of these traditional frameworks tend to work well in terms of being able to hedge risk from a portfolio perspective. So commodities are often cited as an opportunity to gain that inflation hedge. And so, as you mentioned, in this current environment in many countries, there is concerns, particularly in the United States right now, about whether there's going to be big spikes in inflation. And it really depends. As you mentioned, precious metals may not be a place where we've seen those opportunities exist. Some people are pointing to the potential of oil markets as another possible opportunity to take advantage of during periods like this. But again, perishable agricultural goods are not going to necessarily fall into that category as well. So I think investors have to be careful because there's a lot of different types of commodities when you're looking at trying to hedge against concern with inflation. The traditional framework, as you mentioned, where we run to gold, doesn't necessarily hold up in more recent times.
Yeah, and I guess you could link that maybe that they don't have a high expectation that this inflation will be long term. I think they're sort of buying into what the Fed is saying.
I think that's a very good point. I think that it's we tend to get these quote unquote scares anytime the economy starts taking off. And I think the Fed has been pretty clear about the fact that this is not something they expect to see that would be taking place for a sustainable time period. And if for that were to occur, they're on top of it and they look at measures to try to curb that inflation.
Yeah, definitely. So when looking at sort of alternative investments, what would you say are the greatest misunderstandings about them? I'm not sure if you've heard many.
I think that the biggest misunderstandings for many investors is for them to not think about how they fit into the greater portfolio. So they will look at a particular type of investment and say, wow, this alternative investment is really risky. But if it's got a low correlation with the traditional assets in your portfolio, it can still lower your overall level of risk, even on a standalone basis, if it's risky. I think another common misperception is because there's not a lot of information out there, a lot of investors are very squeamish about trying to pursue these alternative investments. And I think also many people think that they are shut out of these investments because they don't meet the minimum criteria for what would be a direct investment into some of these alternatives, that they're not, again, the term we use in the US is an accredited investor. But as I mentioned, there are these other products that are out there, ETFs and mutual funds, that are often mimicking that performance. And to the extent that you can find funds with good track records that can do that, it still can offer you similar type of exposure that you would get from the underlying type of investment.
Yeah, definitely. So you'd say information, while there isn't much information on all these investments, there are still opportunities for them to invest in it.
There are, and I think anything new, we see an analogous situation is, we would think about the equity markets. Many investors have kind of a home bias. In other words, they tend to be drawn to equity securities that represent literally companies that they drive by on their way home from work. And so as a result, we tend to overinvest sometimes in domestic securities, and we don't look at other, say, international opportunities. Same thing I would think would occur here. Most people don't, they have a harder time conceptualizing what some of these investment opportunities are because it doesn't represent something they drive by on the way from home from work.
Yeah, definitely. So, Greg, thank you so much for joining the podcast today. I've just got one more question. So,
Sure.
Sort of, what is the one message you'd like people or investors to take away from the book?
Well, I think I would say the biggest message from the book is that while certainly there are a lot of sources out there that can be very overwhelming and daunting, I think that this book would be very helpful for someone who wants a kind of an introductory view. We use a question answer format to address questions across these 5 different types of alternative investments. And at the end of each of the chapters, we give websites and places where they can get very clear information to be able to discover if this type of exposure is something that would be of interest. So again, I think that it's written at a level where you certainly are going to get a comprehensive view of these different alternative investments, but it's also written at a level so that you don't have to feel overwhelmed or intimidated, and there are information sources out there to help.
Yeah, perfect. And I found that as well. I found it very useful and very simple for me to understand. So, Greg, thanks so much. If someone would get in contact with you about the book or maybe buy the book, where would the best places for that be?
It's obviously, if you go in any online sources, you can find it as well. It's published by Emerald. So, you can purchase directly from, the publisher. But again, all of your online sources like Amazon, so forth, they're going to be carrying it. And, some of the your local bookstores could potentially have it or could order it for you, certainly. But it's readily available, through that web search.
Perfect. So yeah, Greg, thanks so much again for joining the podcast.
Thank you. Appreciate the time.
Thanks.